Hi everyone, my name is piterpakulski. Today I would like to show you the final version of the financial model of a store. This can be a clothing store, this can be a shoe store, and today I would like to show you what parameters affect this business model, what different entrepreneurs want to play with when they finish financial modeling, when they finish building cash flow statement, let's go through the model and I will show you what parameters influence the final financial efficiency of this business idea if you want to start this business, and what type of financial model I advise you to create to play it accurately, the amount of financing, the real amount of financing that you need to start your new business idea. So let's talk about a little bit about how the financial model is organized. So we have two collections, spring summer collection and autumn winter collection. In each of these Microsoft sheets we describe all items that form this or that collection. We describe pricing, direct costs. I will go through all these parameters. Then we consolidate the model, the revenues, direct costs. We add investment plan, payroll, fixed costs. Then we move to cash flow statement. Then we create very simple tables like revenues, expenses, net profit, profitability, to make you able clearly see what is the simple figures of the business, what is the revenue, what are the expenses, what is the profit. Then we can see the simple and discounted payback period diagram to make you see as a picture what is the result of your business idea. Then we have a spreadsheet where you are able to see the financial efficiency, like simple, discounted payback period, net present value, amount of financing that you need, internal rate of return, and here you're able to execute financial stress tests, sensitivity analysis. I will show you how you can do that. So let's start from the very beginning. So first of all, when you if you have some business idea about the store, you may have two collections. For example, one of them is spring summer and the second one is autumn winter, and you start describing when you start the revenue of each collection. For example, let's take spring summer collection because it's the first spreadsheet, and we assume that we start selling our spring summer collection on the March of each year, and the first time when we will start selling this collection will be March 2022, for example. And our collection will consist of these items. So here we just name shorts, different types of clothes, so we just name them one by one. All blue cells are inputs, all other cells are automatic, so you as a user of this financial model, you use only these blue cells. All other cells are automatic, so blue cells with white numbers or text is user interfaces where they put the data. So this is the input, this is the inputs, this is the inputs, this is an inputs. So you start with naming all your collection items. Then you can switch on. Usually when entrepreneurs are finished with their financial modeling, they see simple and discounted payback period. They always want to assume what will happen if I, for example, switch off this or that item from my calculations. For example, if I'm, for example, an optimist at this moment, what will happen if I switch off different items from my calculations, from my financial model. What will happen with simple and discounted payback period? And now I see that how these numbers affect the financial efficiency. So that this is very important for any entrepreneur to see how this or that input affects the final financial efficiency, how it affects the amount of financing needed to start the business. So you can easily switch on and off each item from calculations from our financial model. Then you start describing the cost of production of each item. Once you are done with that, and when you see the results, you see the payback, simple and discounted payback period. You may also assume, for example, if the cost of production will increase on 30%, for example. So you just do like this without adjusting the inputs. So it allows you to quickly create lots and lots and lots of scenarios. So you just go to simple and discounted payback period and see how this or that item affects the financial efficiency, how direct costs influence financial efficiency. Or, for example, you may say that if
I decrease direct costs up to 50%, for example, we will take 50% of today's direct costs. What will happen to financial efficiency? We just use this coefficient, then we go to simple and discounted payback period and see how it affects and decreases the simple and discounted payback period. So, and you can play huge amounts of data just using this coefficient without retyping huge amount of numbers. So we just use the system of coefficients that we already created. Then we can do the same with the starting prices. So these blocks of inputs, they describe the direct costs. This block of inputs describes pricing, the starting pricing of our collection of each item. Here is the starting price. We also have a coefficient to price. For example, we can increase and decrease the percentage of a price and see what will be the financial efficiency if the prices of collection will go selling prices will go up or go down. Starting prices is very important usually when entrepreneurs build financial model and see the results. They want to play with numbers. What will the pricing go up? What will happen if prices go down? So this is very important. You can easily play with data without retyping huge amounts of prices. Then we have the same block with quantity of items that we are going to sell during the period when we sell our collections. This is the amount of items that we order on factory where we produce all our items. And we also have a coefficient to the quantity, so we can play all this data very quickly and see the financial results. So this block describes the names of items. We can switch on and off different items. We can increase and decrease cost of production. We can increase and decrease pricing. We can decrease quantity that we are going to sell. Then we move forward. Then we describe the price discounting during the period when we start selling our collection. When we entered March, March appears here, and then we have a 12 month period when we sell this collection. And at the first month we have 0 discount to all pricing. Then we have 3% discount. Then we have 5, 15%, 25%. So we can adjust the level of discounting. For example, at the end we're going to have a sales, and discount will be maximum. So here in this line we describe the price discounting during all the period when we sell all our collection. Here is the month, and we have 12 months period of selling. So we just take this amount, and during this period we take this price, starting price, and then we start discounting it. Here 0 discounts, then 3% discount, 5, and then we go further in the future, and discounts are going up and up. Then we describe the quantity of items that we sell each month, and we assume, for example, that on the first month we sell 25% of all items that are in our collection. On the second month we sell, for example, 14% of what we have in quantity, and during this period we have to sell 100% of collection. So here we describe discounts, here we describe quantity of items that we sell during the period, and then we describe direct costs concerning this collection. For example, here is the cost of production that we already calculated. Here we can type, for example, the costs of logistics, advertising, some taxes, some expenses concerning transport, whatever. So here we set up all the direct costs concerning one collection, plus to cost of production. Then we allocate all these direct costs inside the timeline. For example, in March we start selling our collection, and before this period we allocate 100% of direct costs, and we take each direct cost item and assume, for example, that in March we start selling the collection, and before March we will pay to the manufacturer. In November we'll pay 70% of cost of production. In February, right before March, we will pay 30% of cost of production. For example, the next item will be paid 50-50 in January and December before the revenue. So here we just go to the past from the moment when we start selling the collection, and we just have these expenses, and we allocate the percentage of these expenses inside this timeline before we start the revenue. Then we do the same with autumn-winter collection. So we just assume that autumn-winter collection will start selling in November. The first collection will start selling at 2021 November. Here we also describe the items inside this collection, and we can switch it off, on and off different items. We have the same blocks for costs, direct costs. We have the same block for pricing, for quantity. Then we move to the consolidation block. We just take all the revenues and all the revenues from these lists, direct costs. Then Microsoft Excel calculates the first moment when we start operating activity. It's November 2021. It's done automatically. Before this moment, we have our investment plan. For example, we need to make some construction for our store, offline store, to buy some equipment, so different items before we start operating activities. So here we just name investment items. Here we specify how much money we invest in this or that investment item before we start operating activity. So this is the moment when we start, and before this moment we specify the expenses during the investment stage. Then we do the same with fixed costs, for example rent, advertising, other different fixed costs items. So we have a typical year, so fixed costs may have some seasonality, so we just take the typical year, where we from January to December specify the values of expenses for this or that fixed cost item. Then we talk about payroll. We name all our positions. Then we specify the salary for one person on each position. Then we have a typical year where we can specify the amount of people on each position to calculate the payroll. And this payroll starts right from the moment when we start operating activity. So this is automatic. Then we specify, then we go to the next spreadsheet, and we specify different taxes. For example, we have revenue taxes, profit taxes, payroll tax, asset tax. We specify the values of these taxes. And finally we can see the cash flow statement. Inside the cash flow statement we have revenues, which you can click the plus button, see the detailed revenues of each collection. Also you can click plus to any other line inside the cash flow statement and see detailed items inside this or that revenue or expense. Here you can see the result from what is valuable about this table. Here you can see the net profit from operating activity. Here it is. Here you can see the investments before you start operating activity, how much money you need during the investment stage. Here are the expenses that you have to pay to manufacture the first collection, to produce the first collection that will form your revenues. Then Microsoft Excel calculates automatically the amount of financing that you need yourself from your pocket. It is your financing. You may also add a loan. Here you can specify the amount of loan. You can specify the month when you get this loan, the month, year, the amount of loan, interest rate, the term of loans in months, then grace period in months for principal payments, and grace period for interest payments in months. So here you just specify, here you can see the payments of principal, and here you can see interest payments. So we take the loan and start paying principal and interest. And inside the cash flow statement you can see what is the cash balance at the end of the period during at the end of each period, at the end of each month. And here you can see how the cash balance is growing, how your business idea is financially breathing. And here you can see the total amount of financing needed for equity, loan and total. Then on the next sheet you can see very simple table which shows you the revenues, total expenses, total profit in your pocket, profitability. This is the two lines for simple and discounted payback period diagrams. Here they are. Then we specify our discount rate and step of changing discount rate to calculate internal rate of return, which goes here. And when you are done when you build all financial model, you just want to see how this or that input affects, for example, the financial efficiency, and how you can do that. We have a parameter, it's marked with red, and you can add this parameter and press sense button to see how this parameter, the increase and decrease of this parameter affects the financial efficiency, which is placed here. So we can go to, for example, spring summer collection. We can go, for example, to costs, and we can for example add this coefficient to so we just take this coefficient add this coefficient to direct cost, the cost of production. So now we just extrapolate this formula from top to the bottom. Here we can see how our coefficient for sensitivity analysis is added to this formula. Then we go to sensitivity analysis spreadsheet, and we just want to see we set up the pace of adjustment, increase or decrease, let it be 5%. And then we press sense button to see how the cost of production affects the financial efficiency of your business idea. Also, we can, for example, disconnect this parameter, for example, from cost of production. And we can link this parameter to, for example, quantity of items that we are going to produce. So now we will extrapolate this formula. So we can add the parameter of sensitivity analysis to any input of inside our financial model. So this is very important when entrepreneur wants to see how his or her business is performs, if revenue increases or expenses increases or decreases. So we just go to sensitivity analysis. For example, I would like to see this. We can change the step of adjustment. So sensitivity analysis is very valuable instrument when you have your financial model done and you want to play with it, with numbers without adjusting the numbers. You're just playing with coefficients, and you don't have to retype a huge amount of information, making mistakes. So sensitivity analysis is very valuable instrument when you just need to figure out how your business is flexible towards the decrease, for example, of revenue or increase of expenses, what will happen if this or that happens. So and lots of entrepreneurs create hundreds of scenarios, connecting, linking the parameter of sensitivity analysis to this or that input item. They just press send button and see how the business will perform if this or that will happen. So I will put all the links how I created this model from scratch at the description of this video. Also, you may buy this model. I will give the link in description of this video. Also, as usually, you can order a financial model from scratch for your business idea. We can help you with that. So see you next videos. Thank you for watching. Subscribe our channel. Bye.